Hello and welcome to the third episode of The Economy Ruins Everything. My name is Walter, I'll be your host, and today we're going to be talking about financial assets, which are the third and final megastructure of our economy. Now, you might ask, what are financial assets? And that's a good question. So, I've done a Google search, and it comes up saying financial assets are non-physical liquid assets that derive their value from a contractual claim or ownership right, such as stocks, bonds, bank deposits, and cash. So, non-physical. I guess cash can be physical, but it's also in the digital world, so that would be non-physical. In any case, financial assets are the third megastructure alongside GDP and combined debt. All right, so let's flip over to the Federal Reserve Bank of St. Louis and the website page, Households and Nonprofit Organizations, Total Financial Asset Levels. And here we have, for the fourth quarter of 2025, a level of $143,865 billion. Now, just like the other graphs that the Federal Reserve Bank has put up, the scale along the bottom is time in years, in this case going from 1945 all the way up to 2025. But as with the other two, debt and GDP, we're going to be looking at things from 1952 onward, because that way we have a common set of facts from a source that's reliable. All right, now I want to talk about the scale on the left-hand side. This scale reads in the millions of dollars. The lowest number is 0, of course. The next number is 20 million millions. The next number is 40 million millions. All right, that's a little confusing, isn't it? All right, now I want to show you very quickly here. The scale on financial assets is in the millions. A lot of millions. This is gross domestic product, and the scale on the left-hand side was in billions of dollars. This is the graph for all the debt, and its scale is in trillions of dollars. So, I find it very interesting that the same organization essentially puts out all these charts, but the scales are not the same. Now, the reason is pretty simple. It's because this is the page and the chart has got to fit on the physical page. All right, so we have trillions of dollars here on debt, we have billions of dollars here on GDP, and we have millions of dollars. But I'm going to go back to debt again. Debt is measured in the trillions, and it says 20, 40, 60, 80. Pretty easy to read. All right. Gross domestic product is measured in the billions, and they start out their graph at 4,000 billions, 8,000, 12,000 billions. And then, of course, we have financial assets, which are measured in the millions of dollars, but the scale is using 20 million as its lowest point, that lowest line above 0. So that makes it hard to really look at these in relation to each other. And in order for us to really understand them, we have to look at them in relation to each other. That's hard to do with separate pages and separate graphs with separate scales. So how do we solve that? Well, I combine them all into a single drawing at the scale of $1 trillion per level. And by level, I am once again talking about Legos. This is a Lego brick, 4 pins across, or 4 pins long, 1 pin wide. And from that, I have constructed this demonstration block set with levels of purple and yellow, purple, yellow, purple, yellow, each level representing $1 trillion. All right, now in my drawing, I've drawn each level to the same scale as these Lego blocks. Just like this, 1 trillion, 2 trillion, 3 trillion, 4 trillion, alternating levels so that they're easy to see. Okay? All right, so let's go to the drawing now. So if you've watched the first 2 episodes on debt and GDP, this is a familiar sight. This is what I call the level playing field. It starts in 1952 when we have data for all 3 megastructures. And it ends in 2025, right here. We have the different generations represented on the side here: baby boomers, Generation X, millennials, Generation Z, and Generation Alpha. I was born in 1961, so that is about here at the tail end of the baby boomers. And you can see here another arrow pointing at the Nixon shock and the gold standard being removed from our currency. And here at 1974 or 75 was the introduction of the tax-deferred retirement plans, which will become important later on. All right, so we've already talked about GDP, which I'll bring up here. And there is our GDP in trillions of dollars. This last one at 2025 is 31.8 trillion. All right, so let's bring in debt and look at it. There we go. And as you could see there, we covered this in the second episode on debt. Debt is so much greater than GDP, more than doubled, and it has never been paid down along this entire history. Debt has never been lower than GDP. All right, so it's raised each and every year. All right, now, finally, I'm going to bring in financial assets. Now, these are, as I said before from our Google search, these are non-physical assets that derive their value from a contractual claim or ownership. And here we go. There is financial assets. And hold on. Would you look at that? Financial assets is by far the largest of the 3 megastructures, surpassing debt by a long shot. Now, let's go to the layer that I call in reality. Here's our level playing field. I'm not going to remove the level playing field this time. Let's put in reality what debt looks like. Remember, debt is a hole. When you have debt, you're standing in a hole until you can pay back that debt. You're not standing on the level playing field. So that means debt is a hole. The graph goes down, not up. And GDP has to start at the lowest level of the hole that you're standing in, or that we as a society are standing in. A society and a country. All right, so there we have debt and GDP. That's a sorry sight to see. And then, in reality, here are financial assets, which stand above both debt and GDP. Now, we've heard tell of something called a K-shaped economy. I say that in reality, we have a Y-shaped economy turned on its side, or perhaps a V-shaped economy would be more accurate, because we don't have a single stem here, but it is far narrower in the early years than it is in the current age. This towering structure is $143 trillion. That is simply astonishing. But it gets worse. This chart represents the gains and losses of the year. It's not the entirety of GDP or debt or financial assets. It's simply the amount gained from the previous year. If we look close, 1957 here, it looks virtually flat. All right, but one thing you start to notice if you come in very close, financial assets in 1953 are slightly more than the debt, and more still in 1954. And if we look along the entirety of this three-dimensional chart, there are very few, if any, years when financial assets are not growing faster than either debt or GDP. All right, now, as it turns out, financial assets are the only structure that finds itself with losses in a year. In other words, not as much. Or excuse me, it's not the only one. GDP also suffered some losses. And here we see losses for GDP here and here, losses for financial assets right here. Okay, and losses for GDP here, losses for financial assets here. All right, our baseline is right here, right there. All right, so, all right, I apologize for the shakiness. We have a train going through right now, so it does shake things up a bit. All right, so I've restored the level playing field, and as you can see here at this top line, that is the level of the playing field right there. All right, so we have in 2022, we have a significant loss in financial assets. So they did not achieve the same level that they did in 2021. All right, so the same thing is happening back here in 2008. All right, that's when we had the housing bubble crash. All right, you can see that GDP suffered a loss right here. Let's see, that would be in 2018. All right, but for the most part, everything gains. But financial assets do suffer some setbacks. Now, I want to tell you something about this. Each one of these, where the financial assets drop below the line, right here, that's actually a loss on the record. But you know what this represents right here? 1, 2, 3, 4, 5, 6, 7, 8, 9 trillion plus a little more pulled out of the market in cash. Now, 401k holders and IRA holders, they cannot do that, not without suffering a penalty. and certainly not in those sums. Guess who pulls out that kind of cash from the financial asset market? It is the people at the top, the 1/10 of 1%. They cashed in right here. They cashed in over here. Every time that financial assets drop below the level playing field line, that's when the wealthy are cashing in and getting out of the market. All right, now it happened in small ways in the past, which you can't really see when it gets that small, but that's what the story is. So there is our rigged economy. Now I'm going to go back. Let's pull up the even playing field in reality. Let's pull back up the GDP and the debt and the financial assets. Take one final look at this. If you want to know why we're having a cost of living crisis, it's because this is what we've spent the last 70 years building. We haven't been building bridges or factories or infrastructure. We've been building boatloads, cargo ship loads full of wealth for the wealthy. Okay? That is where all of our money is going. And it's being drawn there because part of this debt, whoever's holding the debt, whoever owns the debt, that's considered a financial asset. That is a portion. If I take GDP away, if you were to flip this back up, actually I can show you. The portion of debt that you see there is financial assets. The rest of this is all stocks. That is the stock market right there. The stock market draws an incredible amount of money out of the economy and away from the people who create the wealth, which is you and I. All right, this is the problem. This is the cause of our cost of living crisis. It's an artificially created problem. It's not natural. It's not normal. It is what has been foisted upon us. And I can go on, and I will in a future episode, about how things have become so distorted and how we have literally been brainwashed into accepting this as just the way it is. All right, that's all for now. We'll see you in the next episode.